Good afternoon, everyone, and welcome back. I am Bill Spaniel. I'm the head of the Supervision Department at the Federal Reserve Bank of Philadelphia, and I'm glad to introduce and moderate with Stein, Berre, one of my counterparts in the Federal Reserve Bank of New York, a regulators panel on innovation, on Fintech, and on a wide range of topics. First, let me say I've been very, very impressed by the discussions today and yesterday in terms of the opportunities people see, the chance for inclusion, the innovation that we see. And, I think people's understanding that there are many points of views and the regulators have to work on their points of views and within their statutory requirements. And that we should work together, which I think you'll see today that we do work together a great deal on a number of these. I would also say that while Fintech and all the things we've talked about pose tremendous opportunities, they also pose risk. And regulators are in the risk business. It's what we live every day. So we may get a few views of, while this is opportunity, it needs to be in a way that accounts for the risk, whether those are operational, financial, or consumer related. Those risks are important. But let me stop now and turn it over to Stein, Berre, who will introduce our panelists, and then we'll start with the panel discussion.
Thank you, Bill. And I think we have an outstandingly good panel today, all around the topics of innovation and regulation and supervision. Let me first introduce Ann Epstein, who's Assistant Director of the Office of Innovation at the CFPB. We also have Beth Knickerbocker, who's the Chief Innovation Officer of the Office of the Comptroller of the Currency. Sultan Meghji, who is also Chief Innovation Officer at the Federal Deposit Insurance Corporation. John Ryan, who is the President and CEO of the Conference of State Bank Supervisors. And Lisa Ryu, Senior Associate Director in Supervision at the Federal Reserve Board. So a fantastic group of people to kick this off with. I will get a little housekeeping out of the way since we are all representing regulatory points of view. We are all speaking in our personal capacities, and what we're saying today should be seen as such and not official policy or a view expressed by our respective agencies. So got that out of the way so we don't have to hear it 5 times today. I thought I might kick things off with something of an extended analogy, which I think kind of brings together some things we've heard over the last few days. So when we think about regulatory perimeter, I think one analogy sometimes gets used is the idea of kind of where do you set your walls? I think the idea here is if you imagine a medieval city, imagine kind of London, they have a wall around it, but over time, the city kind of grows beyond the walls. I think that's kind of the world that we've lived in with shadow banking, with kind of new forms of financial risk that can ultimately impact all of society and the whole financial system. Question is, do you build higher walls? Do you extend the walls beyond the perimeter where they are right now? I think as we've been listening over the course of the last few days, maybe the question about walls isn't exactly right. With all the ways that you partner or technology changes the way that banking is done, maybe it's more the case that the enemy isn't wearing a uniform anymore. And maybe some people in your town have invited the enemy inside the city walls to begin with, right? So, but then on top of that, when you listen to the last section, I think one of the things I took away is, well, not just that, but maybe it's the case that you have different teams of people manning different sections of the wall. So that kind of gives you a sense of maybe some of the challenges that have been suggested in the course of the last couple of days about regulatory perimeter in this environment. So I thought one way to kick things off would just be kind of pick that up a bit and talk about this basic idea with all the change going on, with the changes in technology, business model, impacting almost every part of financial services, as we've been hearing over the course of the last few days. How does this concern you, and how should we be thinking about the bounds or limits of the current regulatory perimeter? If I may, I thought I might put that first to Beth to get your perspective, and be very curious to hear. What do you think? How should we be thinking about regulatory perimeter?
Well, thanks, Stein, and thank you to the Federal Reserve Bank of Philadelphia. I've said this to a number of people. This is one of my favorite conferences every year. I think the conversation is exceptional, and thank you so much for the invitation to speak today. I greatly appreciate it. Great question. I think it's one that all of us on the panel probably wake up thinking about and go to sleep thinking about, because it really is an interesting time in bank regulation. As you said, all aspects of banking are evolving and innovating. I can't think of a single aspect of banking that hasn't had some sort of innovation or some sort of new way of doing something that has occurred in the last, even last year, let alone the last couple of years. And there are a number of sort of points about that I think we need to think about when we talk about the regulatory perimeter. So the barriers to entry are significantly lower. You can set up an API that is a banking API, and as long as you are perhaps getting a state money license, or you're partnering with a bank where you don't even need a license, you can almost start doing your product right away. And so those barriers are lower. The technology enables a whole bunch of different ways of looking at banking. Bank fintech partnerships and relationships help. And then there's so much funding out there that there's really a whole expansive view of banking that we haven't even thought of in the past. So that really raises a lot of concerns about the regulatory perimeter. Where should it be? A lot of questions about level playing field. We talk a lot in regulatory speak about same activity, same risk, same treatment. Just a note of trivia, I actually just Googled that yesterday, and in Google I had 7.8 billion hits on that term alone. So there are a lot of people talking about that. But what does that mean in this new era where there are so many different parts of banking, and really banking's becoming a stack on top of a stack of technology, and there are different players around that. So I think we as regulators really need to think about what is the purpose of regulation? What are the interests that we are trying to protect? Obviously, we try to protect consumers. We try to protect market integrity. We try to protect the trust around the banking system. And how do we go about doing that in this very complex world? And the Comptroller talked about that a little bit yesterday in his opening remarks to this speech. And it's something that all of us on this panel and others on this conference will be talking about for quite some time.
Thank you, Beth. Sultan, maybe I could ask you to elaborate on your thoughts on the same question.
Well, I have to say, I always love going after Beth because she says all the really smart stuff, and then I can give a glib and lightweight answer. But first off, thank you guys for having me. This is my first time here. It's been an amazing program. I got to hear the words quantum computing when I signed on a few minutes ago, and I knew that meant the conference was going in the right direction. I'll give a slightly different perspective on this because, unlike everyone here, I'm more recent to the regulatory community. I come from 30 years in tech. And so I've been on the other side. I've been on the side of pushing the boundaries. I've been on the side of bringing these new things to market. And so to me, while we have an absolute requirement to keep the system safe and sound, to protect consumers, to protect the national economy, we also have to realize that in many ways, the existing regulatory landscape isn't quite set up to deal with a lot of these new technologies. And so there's a lot of incremental activity that we're doing, just adding things like putting multi-factor authentication into guidance. That was a great thing, long overdue, useful to have. But we also have to think about maintaining space in the system for innovation, because it really comes down to, do we leave space in the system for innovation or do we not? And then it stays entirely outside. And then it becomes a much harder problem to bring it back in. I mean, we're seeing that in certain areas already. I am incredibly encouraged by the partnership activity, by the work amongst all the agencies represented here and others to create space for these discussions, because like so much innovation, we don't actually know where this is going to go. We don't know what the end result of this is going to be. We just know that we have some true norths we have to follow, and that we need to make sure that we're holding up our statutory authority while at the same time making sure that there's opportunity here. The last thing I think any of us want is for the U.S.'s banking system not to be the backbone of the global financial order like it's been since 1945. And we really need to make sure that these are included. Now, coupled with all of that is, of course, the fact that there's a lot of legacy technology out there that we have to get around. And in many cases, the regulatory system needs to balance the need to bring those things up to date as well as allowing new entrants in, but then also allowing new players to play on this playing field. There are a lot of moving pieces. I think we could talk about just what's in my inbox, just what's in Beth's inbox, probably for 4 hours in terms of all the different threads that we're working on. So this is not a small discussion. It's not something we're going to solve tomorrow, but I'm encouraged that so many of us are having these discussions together, working together, and trying to find common ways to move forward.
Great. Thank you, Sultan. John, you bring the state perspective in, which has a lot of different perspectives with it. I'd be curious to kind of hear how you think about this question of regulatory perimeter.
So I approach this, our members approach this from a very broad perspective of one, chartering banks. We have about close to 80% of the banks, most of those being the community banks in the US. We also have responsibility among state bank regulators for supervision of aspects of the non-bank space, money transmission, consumer lending, mortgage origination, non-bank mortgage servicing. So to your question about the regulatory perimeter and the rapid change, it certainly has our attention. I know it has all of our attention, the entire, everyone on this panel, about the rapid growth of the non-bank sector, fintech and otherwise, almost all of it fueled, but not necessarily all fueled by technology. I think government guarantees in there have an impact. And so the growth of that non-bank sector and the interconnectedness of our entire financial sector. Beth alluded to this. Sultan makes reference to in terms of the ecosystem and where innovation is occurring within and without the banking system. So we are doing a lot of thinking about this, and I want to give some encouragement for the audience. While we have a fragmented system of regulation and supervision, there have been reasons behind that I won't go into. But we are conceiving in our role as bank and non-bank regulators a really networked and federated system of state supervision. We already have this on the bank side, but particularly on the non-bank side, and that it's networked between and among the states, but also with our federal counterparts. So that interconnectedness, what the OCC may do related to a mortgage subservicer may have direct impact on non-banks that we regulate. We all need to be talking together, and we're encouraged by what's happening at the federal level, the conversations we're a part of, and future conversations. Giving you just a quick sense of what's happening in the states that I think will be encouraging in the non-bank sector. States have recently developed a new model law for MSBs that has a crypto component to it. So this as it relates to payments and looking across the entities. One of the challenges the Comptroller has raised for prudential standards in a coordinated fashion between and among the states. The states have come up with new prudential standards for non-bank mortgage servicers. The states have created a technology platform for licensing and supervision, have come up with agreements to look at company applications across the states. So we're talking to each other. To the perimeter, is this complete to meet the challenge? No, probably not. Are there state and federal rules that need to be worked out? I'd say yes. Beth, to me, asked an important question. What are we, and Sultan has said the same thing, what are we trying to solve for? At the federal level, some of it, we do treat banks differently. Their liabilities are guaranteed. That has been extended to the money market mutual fund. There is unevenness in how we regulate the money market mutual fund industry versus banks. What unevenness is appropriate, and as we look in other areas, is there consideration that federal government is going to be forced to extend the protections of the safety net to uninsured entities? These are all questions that I think we need to be considering. What's the role? What are the objectives? But I would say we're actually trending towards more even with the establishment of the FSOC, the work it's been doing related to money market mutual funds, the consideration in the non-bank space as a whole, the work of the CFPB in creating greater evenness on the consumer protection side. So there's progress, definitely more to be done, and we don't necessarily even know what the system is going to look like in the next 5 years. But certainly we have to be thinking about it, working as a network together of regulators.
Thanks, John. Lisa, your team thinks all the time about these points of interconnection that John touched on. Maybe we could get your perspective about what you think as kind of the key dimensions in thinking about regulatory perimeter over the next several years.
Thanks, Stein. And I'm very excited to be on this panel. This is my first time participating in this panel. And I am on this panel with many colleagues that I talk on a regular basis, which is another plus on my side. So, my background is also a little bit different. I'm not a chief innovation officer like many others, but my perspective comes from supervision, and that is my areas of focus. But in terms of the questions about the regulatory perimeter, I think I would like to step back a little bit as to why do we regulate and supervise banks. And then I think that will lead to how we should think about the regulatory perimeter. I think Meghji yesterday mentioned a little bit more about the uniqueness of the bank, and initially most of the original thinking around the regulation and additional supervisory scrutiny around banking was under the premise the bank was special. They are special financial intermediaries, and so they take deposits and transform that into credit, and there's a credit intermediation, things that happen and encapsulated within a single entity, and therefore there was additional regulations and so forth to protect both the safety and soundness of that institution that provide those credit and do the liquidity transformation, but also the potential to prevent the potential negative impact of any failures coming from that, and there was a financial stability aspect of it. So now we are in this stage where much of the banking service is not solely encapsulated within the banking industry, and I think technology comes in. I think it even perpetuate or expand what banking service means, is because once again there are many parties involved in providing particular services. I think listening to this FinTech conference, it becomes even clearer as to how many parties are involved in that and how many questions are involved in that. But I think the basic principle perhaps of a regulation hasn't really changed as to we are trying to make sure the entities that provide a fundamental financial services and financial intermediation or credit intermediation services and using the deposits provided to consumers remain safe and sound. And so I think this increasing interconnectedness between many among the technology providers, banks, and when I say technology providers and banks, I'm not even talking about singular on either side. I think there are many parties involved to provide their services and remain as an ecosystem, remain safe and sound. And so I think that raises a question about what is the right level of regulation to ensure the services are robust and protect the financial stability and the consumers and so forth, as Beth talked about. So I think that's the question we are asking. So I would say, there have been a lot of innovations, and I think innovation is good. And I always call myself a sci-fi nerd who grew up reading a tons of the sci-fi books. But sometimes I'm especially listening to quantum computing discussion. I feel like I have arrived with the with the sci-fi kind of rhetoric. But I think there have been quite a bit of inflection point. I think to me, the inflection point may be not a one-time inflection point. I think there are multiple things that's coming. And while the industry is transforming as a result of technology, I think what the final kind of landscape or ecosystem will look like in the financial system is not yet clear to me. But in the meanwhile, I think as a supervisor and my colleagues kind of looking at it is how can we be adopting the way we do supervision to the way we are thinking about a interconnectedness between the banks, technology providers, or otherwise, and see where the risks are. And how best for us to supervise those entities. I think that is the focus of our current thinking on the supervision side. I think there are some to catch up to, the technology understanding, but in the end, I think technology is just a tool. And the question we are asking right now is, how does technology mitigate or amplify the existing risk, and what additional new risk is being introduced as a result of technology? And also, what does it mean? Where is the weakest link in this interconnectedness link? And I have said many times recently that the resilience of the financial system, or the way delivery mechanism is very much dependent upon weakest link, because they may create the biggest vulnerability in the system. So that comes from both operational size, in operational risk, or lack of operational resilience can translate into the financial risk and liquidity and what otherwise. So I think those chains are what we are trying to understand. I will reiterate, I think, things that have been said earlier, that we as regulators and supervisors are working very closely together across the agencies. And I think we all understand the necessity of doing so in this new space. And I look forward to further collaboration and discussions going forward.
Well, thank you, Lisa. And I think the panel so far has explored some of the aspects of innovation, some of the aspects of prudential supervisory perspective. And maybe I could take it to you to kind of bring in the consumer protection aspect of this, and thinking about what does the regulatory perimeter do in terms of your thinking about the mandate that the CFPB has before it? You may be on mute.
Okay, double muted. Sorry about that. Yes, and I want to thank you for the invitation to speak on the panel and to be with my colleagues. It's a great opportunity, I think, for us to speak about our views, as well as show in many ways how often we do collaborate. And there's numerous examples on that, because as we think about the perimeter and the structure of the each of our purviews, that collaboration becomes very important. And so, I think being able to have these conversations and demonstrate where we do work together, I think is really quite important. Batting cleanup here, I guess I'll just touch on a few things that have not already been talked about by my colleagues. The first is that we do have a different charter than the prudential regulators. So as you are likely aware, the CFPB does have supervisory authority over several classes of non-banks, in addition to, of course, larger banks, thrifts, and credit unions and their affiliates. So we do have supervisory authority over non-bank mortgage originators and servicers, payday lenders, private student lenders, and we also supervise the larger participants of other consumer financial markets as defined by Bureau rules. So today, that includes larger participants in markets such as consumer reporting, consumer debt collection, student loan servicing, international money transfer, and automobile financing. So already, I think, well beyond sort of that perimeter of just banks, but that question of that perimeter, does continue to raise as business models change. One thing I don't think has been noted here, and that is, as the technology that our regulated entities use changes, so too do the opportunities for us to use different technologies to monitor the markets. And the good news is that there are many opportunities to leverage technology ourselves to be more effective in our activities, such as market monitoring, that are able to leverage technology to make our data gathering efforts less intrusive, or regulation publication more easily read and distributed, and use strategies like open source to amplify our regulatory efforts. When we think about that analogy that you talked about of the perimeter walls, as that population grows, we need better tools to be able to effectively regulate and supervise these entities. And I think, I know we at the CFPB and many of my colleagues are innovating and transforming to meet those changing market perimeters.
Great, thank you, everyone. Bill, maybe I'll turn over to you for the next round of questions.
Sure, thanks. So as we've seen through the conference today, and I think as we've all seen through the last 3 or 4 years, there's this continuing movement towards partnerships in the fintech world, partnerships with service providers, partnerships with banks. I would imagine the partnerships extend to the non-banks that the CFPB and the states regulate as well. And these partnerships, of course, hold a lot of opportunity and a lot of innovation, but they also pose a significant risk, sometimes to the bank, sometimes to consumers, sometimes to just the operations of financial markets in general. I thought I'd start by asking people, what are the risks we've seen or the things we would maybe caution people in these partnerships about, whether they be on innovation, privacy, cultural organizations, controls, and those kind of things. And Anne, I'm going to come back to you to lead off this time, and then go to John, who's got a broader, and then come back to some of the banking regulators. But what are these, while there are these great opportunities in these great partnerships, what are we seeing in terms of the risks they pose and we need to be cautious about the mitigants of?
Yeah, and of course, I'll focus on the consumer protection side. And I totally agree. Opportunities and risks. And I think that's the theme for this panel and maybe the theme for the last couple of days. So let's focus on opportunities, financial inclusion, particularly for historically marginalized communities. That's a key priority for the Bureau. And it's important because we know that the current system, particularly for assessing creditworthiness, is flawed and often exacerbates structural inequalities. And the Bureau has put out research over the last several years on 26 million consumers that are credit invisible, and the who that impacts. So Black and Hispanic consumers are more likely to have limited credit records. People in rural communities are more likely to have limited credit records. So we know that there is room for improvement. One example would be the use of, for example, alternative data, particularly financial transaction data, such as from bank accounts, could hold real promise for making that system better. And there's been some interesting research done by FinReg Labs and so forth on that. And the CFPB, along with my colleagues who are on the panel today, so and at least one other, so the CFPB, the Fed, the FDIC, OCC, and NCUA in December 2019 actually issued a joint statement on the use of alternative data in credit underwriting. And it notes that the benefits that using alternative data may provide to consumers, such as expanding access to credit, enabling consumers to obtain additional products and more favorable pricing and terms. But there needs to be protection built into that. So we need to make sure that the flaws of the current system are not recreated. And we also need to make sure that new harms are not introduced into that process. So data privacy and consumer knowledge and expectation that the data that is being used for a financial decision is incredibly important. The data quality and representativeness of the data and the consumer's ability to correct data inaccuracies are all important components if we're starting to think about these things. That statement, that joint statement, explained that a well-designed compliance management program provides for thorough analysis of these risks as well as the opportunities and all the regulations that would apply on these types of things. The statement also notes that consumer permission data, such as cash flow data, is an example of data that's likely to increase credit. And I think the key there is consumer permissioned. So an informed consumer should be in control of their data and its usage. Access and control of their own data allows consumers choice and creates an environment in which competition for their business can thrive. Once you start talking about alternative data and access, the other interrelated area is artificial intelligence and machine learning, because as the amount and complexity of data to determine creditworthiness increases, creditors are turning toward artificial intelligence and machine learning to support that process. And again, jointly with my colleagues here on this panel, the Fed, the FDIC, NCUA, and the OCC, we put out a request for information and comment on financial institutions' use of artificial intelligence, including machine learning. And that RFI specifically addressed the potential benefits of AI in credit underwriting, as well as the importance of data quality for AI usage. And of course, again, benefits, more accurate, lower cost, faster underwriting, expanding access to credit, a fairer system. But the use of AI can also create or heighten consumer protection risks, such as risks of unlawful discrimination, unfair, deceptive, and abusive practices, privacy concern. And another main concern with AI is the opacity. It makes it harder to educate and explain why somebody was denied credit, and perhaps the explainability of what factors somebody can control. And there's potentially undesirable or unintended side effects with the use of data, which could penalize or reward certain groups or behaviors in ways that are difficult to predict. So I think, as we talk about this, and Sultan said, we need to balance both sides of it. The market has already moved forward significantly into each of these spaces, and we're hopeful that the U.S. emerges with a more inclusive financial system. But hope and good intentions really aren't good enough. We need to make sure, as we move forward, consumers are protected. I think one of the reasons I mentioned a number of these kinds of joint efforts is to show that we are really looking at the perimeters and how we can join forces to make sure that we do that and think about this holistically.
Thanks, Beth. So, John, at the start, you are in the enviable position of representing 50 regulators. And at the same time, well, actually more than 50, but at the same time, those states and territories are often the incubation hubs for innovation, and particularly in a federated system as ours. So in terms of those two aspects, what is concerning for the CSBS members in terms of risk and opportunities in this space? John, you're on mute still.
There we go. Thanks, Bill. All the risks that you mentioned in terms of data sharing, privacy, culture, operations, they all exist. What we see is, one, every bank, certainly smaller banks, but I would say banks of all size, need some partnership relationship to be able to innovate and even survive, particularly smaller banks. They can't afford to invest in developing their own technology. They have to leverage others. I'd point everyone to, if you're interested in kind of what's happening in the community bank space around this, the FDIC did a really good report in December 2020. Chapter 6 of that report focuses on innovation in the community bank space. So a lot of the ways that community banks are investing in technology, which rely on some level of partnership, whether it's the core service provider or other providers, are probably not what you would think of as the most innovative. So, the FDIC relied on a survey we did. We don't get reporting as bank regulators on the technology spend. We have, through the examination process, insights. But CSBS has done a survey of community banking for the last 7 years, and we've asked questions around technology investment. So no surprise, 90% of the respondents, community banks, mobile banking is, they've adopted that. That's something that many of us probably expect from our bank. Electronic bill payment, 83%. But you start getting down to automated loan underwriting, which is not the sexiest thing that we're talking about at this conference. That's 12%. I'll just give you another online loan closure, 4.8%. So this was a survey done in 2020. So there is a lot of work to be done if smaller banks are going to be competitive and able to drive down their costs, and if they're going to provide the services increasingly their customers are going to want. Why do we care about this? Because we still see, and we've done a lot of research around this, that relationship, that connection to the community has an impact on the community and lending within that community. So from our perspective, we need maybe 5, 10, 20 years from now, technology will have solved this, but distance still seems to matter in terms of lending and the health and performance of a community. So these risks exist, but our banks need these partnerships to survive. I think this is where we need to be thinking about the ecosystem, the partners. One thing that I think is important that the Fed kind of dipped their toe into with a recent report was saying community banks should look past their cores, even if they're investing, if it's costing them money, to other service providers to have services that maybe their customers really want.
Thanks, John. And Lisa, I want to move to you next, but first I do want to address the question we got in the chat, which is, can we expect the states to have an opportunity to share experiences on this? From my own perspective, and I'd be interested in others, while the CSBS and others may not be on the president's working group, there are multiple avenues for communication between the state supervisors and the federal working group. And this goes back to quite some time. When I even began my career, there was a state federal working group that looked to, can we get our processes and our procedures more consistent? And much of that work continues today. And at least I know all of us have regional outreaches to the states and that. So I think there is an opportunity for states to share their experiences. But as one of the tenors of this conference has been, there's a need for much greater communication and collaboration across everybody engaged in this space to ensure we get it right, whether it's quantum computing, which is frightening in some respects at least, or whether it's just how can we partner? How can fintechs understand the regulatory world, and how can regulators account for what fintechs are trying to do? But I think there is that opportunity for the states to do, but we can always do better. Lisa, comments from the Fed's perspective?
So, I think the question is about the opportunities and risk. I think in terms of the opportunity, I think that has been stated before, but from the banking perspective, obviously, particularly for community bank, partnership could offer, a path for innovation. They may not be able to do it on their own. So I think there is an opportunity there and to allow them to remain competitive with the larger bank and some other providers. So I think there is definitely opportunity for bank through partnership. At the same time, the risk is what we are here to also to talk about. And I think if you look at kind of contractual agreements between the partnership arrangement, I think at times, the delineation of the responsibility may or may not be always clear on that. And so I think there are questions about things like who and who is accountable for a certain aspect of it. And it may be as you develop the different partnership, they may be more customized arrangement of that. But I think understanding those kind of pitfalls within the arrangement will be kind of important aspect of it. I think the one other things that we also focus on in terms of the risk is operational risk. The more partnership do you have, and those partners may also have partners. And so there is a significant amount of connectedness in terms of especially an operational side of it. And that does amplify some risk related to operations. And Bill, as you know, I'm also one of my responsibilities at the Fed is oversight of the significant service provider. There's a third-party service providers that provides significant services to our banks. And even within that context, we always think about third-party risk. But But as with their additional partnerships, I think the question is, how does that fit in with the bank's overall strategy, but also their own control framework and risk? And how do you think about the third party risk, or, the beyond third party nowadays, nth party, the risk related? How does that all kind of be addressed within the context of this partnership? With the three agencies together, I think there's several agencies together. I believe that it was mostly the federal banking agencies. It did issue the due diligence guide, I think, earlier this year to help the community bank, and with a set of questions to ask when thinking about partnering with the fintech companies, and hopefully that is a helpful first step. But definitely kind of questions about the asking the right questions as you are acquiring or getting into the partnership arrangement, but also just making sure you understand the risk framework of the third parties, and also within your organizations and the ability to manage those third party risk. I think those are the important elements. I mean, those are the stuff, frankly, will be very interesting in seeing.
So Beth, I want to give you the last word here on this question, and note that we do have a couple of questions in the panelists that we'll try to get to as we proceed through the panel. But Beth, let me give you the last word on the risk we're seeing with these partnerships and just the landscape of change in general.
Sure. I think that Anne and Lisa and John have covered a lot of the risk and opportunities quite well. I'm just going to focus on one area, which is culture. And you had that in your question. When we look at the fintech bank relationships that are out there now, one of the key things that we see both from successful relationships and unsuccessful relationships is that culture point. And I know that kind of sounds weird, because how can a technology company and a bank, how can those cultures fit? But it's really about the bank and the fintech looking at what do they both offer to the relationship. For the bank, is that product, service, or process fit for purpose? Does the fintech understand the role and responsibilities of the bank in the relationship? Does the bank understand what the fintech brings? And it's not just technology, because a lot of these relationships can be quite complex. So what types of things are they going to be bringing to the relationship? And do they understand what those responsibilities are? And does the bank have the capability of overseeing that? That all fits really into this culture point. And the ones that really understand what both sides bring and respect for the different views that come into this, they can build a very successful culture and relationship.
Thank you, Beth. I may put a follow-up question back to you, because we're talking a little bit about specialization, these different models of cooperation. One particular model by which banks have been partnering with other organizations has been banking as a service. And I'd be interested in kind of delving a little bit deeper, because banking as a service kind of raises this possibility that the bank is becoming a commodity provider and losing control of some of their control perimeter in the process. That, I think, from the perspective of a prudential or from a consumer protection point of view, is worrying. So maybe I could follow on with a little bit more your thoughts specifically to banking as a service and some of the risks that it raises in your perspective.
Yeah, so one of the challenges with banking as a service is, what is banking as a service? And because there are is it a platform? What are the different, there's a lot of different terms there. The way that I would approach banking as a service, at least for purposes of this conversation, is those really I would call them complex relationships between a bank and a fintech, where the fintech or the non-bank is actually the customer-facing entity. And it's not the bank who is typically facing the customer. Non-banks like that because it allows them to provide a whole host of services to their customer base and continue to grow loyalty within that customer base. And some banks find that to be a particular successful strategy because it enables them to actually also grow customers, but also grow loans or deposits, depending on how the relationship works. But it gets very complex when you talk about this regulatory perimeter piece. Who is the customer to whom? And it raises questions under our ability with the Bank Service Company Act to look at those relationships. It also raises questions about what responsibilities and what regulation and safety and soundness issues, where does that reside in terms of responsibility? It also can raise a lot of risk because in these banking as a service relationships, there are oftentimes questions around who owns the customer. And we're regulators, right? So we're always looking at when things go wrong. When there is a breakup, so to speak, with respect to a banking as a service, we've seen situations where if banks haven't planned for it, there can be, for instance, with respect to a deposit taking relationship, there could be a liquidity event with respect to the bank if they're not planning that effectively. There could be fights in front of a customer about poor service levels between the bank and the fintech, and they can be extremely complex relationships. They're growing. I think we all need to learn about that. I think this will probably be a discussion for next year's conference because this is just something that's going to continue to grow and expand.
Sultan, you bring the perspective of having come from kind of a technology innovation background into the regulatory world. I appreciate getting your perspective on this topic of banking as a service, opportunities, threats, and what does the future look like from your perspective?
No, I don't know if I'd say threats, maybe risks, but I think Beth, I highlighted that very, very well. The nature of the banking system has evolved quite a bit, right? And you can't really operate in the banking system without having in your organization a degree of technical competency. And banking as a service, it can go in both directions. One is it's an opportunity where organizations that have great technical competency and great, people skills, process, good governance can really do something interesting and very powerful. And it's a big enabler. There's another definition of banking as a service we haven't covered where organizations are providing, in essence, back office services for banks to allow them to accelerate and manage some of the technology lag and legacy that they have. I'm not going to get into, I don't think there's a taxonomy yet for banking as a service, but I would say that this does highlight in a very real way the fact that many organizations out there are very good at technology and there are a few that aren't. And for those that aren't, they need something faster than just attempting to hire people in a hyper competitive market, in a place where we don't have enough technology staff with the right skills, just in one area, cybersecurity. We could add 500,000 decent cybersecurity professionals to this market and probably still need more. And there's no pathway for that. And so creating opportunities where banks can take the things they're good at, operate them in a safe and sound way, and organizations around them can offer the things that they're good at and find ways to create collaborations is a really powerful opportunity. It does also move very quickly. I mean, banking as a service really took off 3 or 4 years ago, right? The regulatory community is kind of getting to it now. And we have to get a little more proactive about these things, because banking as a service is going to evolve into banking infrastructure as a service, which is going to evolve into, lightweight cores and a variety of other activities just becoming part of the ecosystem, and banking being embedded in a lot of things that aren't traditionally there. And the market's not slowing down. In fact, if anything, it's accelerating. We look at the Web3 platforms that are coming online now, and they're just going to accelerate it even more. And so for me, there is a huge risk that we haven't talked about yet today, which is if we don't do anything as a regulatory community. If we just kind of sit there and incrementally say, status quo, we're going to tweak the perimeter a little bit, tweak this guidance, tweak that, I worry that it's going to actually cause some bigger problems in the next few years as some of these more advanced technologies come online. I would say think about it when we created low-cost trading on the New York Stock Exchange, and right around the year 2000, we took it from $45 a trade to at that point down to basically zero, and now you have the Robinhoods of the world, and look at what that did in terms of the risk to the overall system and what we're having to deal with because of that. We're seeing a very similar activity in the banking sector, but just compressed into a much shorter amount of time, a couple of years versus 2 decades, and so this is. I think a more significant issue in terms of us having to really get our handle around these technologies and get ahead of where the market is going, because the market is moving far faster than we historically have been able to manage.
Thank you, Sultan. And maybe what I'll just do is to one last comment, and maybe I'll turn it back to Bill. We can also look at the remaining questions in the chat before we wrap up. But I'd like to go back to Lisa and follow up a little bit on what you were talking about how complexity and partnership lead to risk, particularly operational risks. And I'd appreciate getting your perspective on banking as a service and the operational and control challenges that raises.
Yeah, and I am actually glad Beth actually defined in her terms what banking as a service is. Because I think there are many different kind of formulation of that. I think in some sense, as we talked about, fintech companies are getting much more into the banking business, and then the reverse is true. And as we always talk about, thinking about the third parties and looking at some of these partnerships, and we ask who is the third party? It's not clear to us anymore. So I think this isn't, I think Sultan's point of view is very interesting point of view about the kind of technology and adoption. And if we don't do it, where does it go? But I think from the banking supervisor perspective, I think I do have quite a bit of questions about a potential operational challenges, and particularly as the institutions take on either third-party relationship to deliver banking as a services. So once again, creating further complexities in the third-party risk related to it, and some other entities and may internalize these type of services. So I think the end result of what's happening in the banking as a service is there's quite a bit of blurring of lines between the banking and technology, but also quite significant third-party risk that is being introduced. So, I mean, one ask questions as whether the banks engaged in this or not. I mean, this would be a natural outcome that's going to happen. But I think once just going back to my earlier thesis about bank and their importance and why they are being regulated and supervised in terms of the financial stability element of it. You raised some question about what does this risk means for in that context of that. And as the world become much more interconnected in the services is being provided, it's not yet clear to me a kind of what kind of the totality of the risk that banks are taking on from the operations wise, and whether they, we fully understand the degree of the third party risk that we are being embedded into it. Cyber is always a big portion of the concern in our world, and how does the interconnected system kind of fares in this new world of the kind of increasing cyber threats and so forth is also not clear to me. And for especially the smaller bank partnering with the fintech partners to be the banking as a service, the back end of the services. I think Beth also talked about cultural differences across the between the banks versus the fintech providers. I think that would be also things to watch out for, and whether there is the appropriate due diligence about the third parties or not. So I think this isn't kind of area that we want to watch out for. I think there are, to me, there are quite a significant operational challenges being introduced in this arrangement, and banks are getting into the business they traditionally were not part of. And so I think with the associated, the opportunities, I think there are also the risks that we need to understand, and as this evolves further.
Thank you, Lisa. And that cultural point, I think, is always an interesting one. I think the words move fast and break things are the kinds of words that no bank regulator ever wants to hear spoken in a meeting. So, Bill, maybe I'll hand it back to you to feel how you'd like best to use the time we have remaining.
I think there's one question in the chat I want to try to get to, and then I think we can wrap up. And I'd be interested. We have a number of innovation officers here, Sultan and Beth and Ann and John has been on the forefront of innovation. One of the questions is, we made mention of data sharing and data privacy, and consumers need to control their data. And I think consumers clearly need to understand their data, who's using it, why they're using it. But the question also says, if they control their data, would that not inhibit our ability to share it and to make innovative processes? So I want to start maybe with you, Sultan, on, this is a balancing act, right, between privacy and people's, clearly concern over their financial assets and how they do their business, as well as an innovative marketplace where things are moving quickly, Venmo and these things. And I think there is some concern. Do consumers understand this? But also, consumers clearly want this kind of innovation to make life easier for them. So how might we try, or how as innovators do we need to strike that balance?
It's such a good question, and it's one that I think we're going to struggle with for a long time because, for the last, decade and a half or so, the fintech community globally has just created these amazing customer interfaces, incredibly compelling new products and services, and definitely they've pulled the market in that direction, right? The thing that I would do is I tend to take things back and shift it a little bit and say, where are the areas where we can have measurable impact to concerns about this? And so when you're talking about, consumer data access, I was really excited to hear Ann talk about open source and open banking, because I think that's a huge opportunity. But I will also say, identity is something that we're going to have to spend a lot more time talking about. Digital identity is not something that we've spent a lot of time with, and as regulators or in the banking sector. And it's something where, we have to start thinking about this as a data conversation, and there's data about the customers and clients of an institution. There's data about the institution and its balance sheet. There's data about the transactions. There's data about its interfaces and API calls and things like that. And getting to a point where we can start to organize that in a way that is meaningful and then educatable. I'm old enough that when I was in middle school and I took home ec and they showed me how to balance my checkbook, an old school paper checkbook, you write down and you balance your checkbook every month. That they don't teach that anymore. My kids certainly have never seen anything like that. And certainly I haven't written a check in quite a while, nor have I gone into a branch in quite a while, right? And so that market is evolving. And so we need to think about new ways to educate. And that to me is, we've talked about culture, which is exciting. But for me, probably the most interesting thing for us is figuring out how to educate ourselves, educate the banks, and then educate the customers so they can make informed decisions, not just about their own data, but also about, the right banking products and services. I kind of make it a point when someone says, hey, I'm going to Venmo you something or something like that. I say, well, that's not FDIC insured, right? And then they're like, wait, that's not? And it's like, okay, we got to do a better job educating people about where the lines actually are.
And maybe your thoughts on this, and then you, John.
So I think the way I would like to think about it is through the lens of ensuring that we have a competitive, vibrant environment for consumers, and ownership of and frankly, portability of data is really about ensuring that consumers have choice, and that promotes innovative financial products because it creates that environment. And I think that that's the part that we need to ensure as we move forward, that competitive nature that, as Sultan mentioned, was really part of how America has created a vibrant system is maintained, and that we don't, as we transition to this newer world, lose that in the process. So that's the lens that I would put toward that balance that we have to have.
John, we'll give you the last word here as we close the panel.
So the state system exists in the roots of the United States in a distrust of consolidated economic and political power. What both Ann and Sultan have said speaks to assumptions of continued choice and competitive markets and reference maybe some of the challenges around the assumption we continue to have a competitive market. If consumers are going to be the beneficiaries of innovation, we really have to be mindful of that. And there are a lot of forces that can lead us to a much more consolidated market with fewer true consumer choices. So that's something we're all going to struggle with. It's, the question of the next decade, probably. How does technology result in greater competition and greater going forward and greater choice rather than limited competition and greater dependency, and not just a too big to fail, but a too big to regulate, a too big to check or challenge.
Thank you.
So I finished big.
Thank you. So thank you, Stein, for co-moderating with me, and thanks to all the panelists. It was really a wonderful group, and I hope people took away so that we are a thoughtful group of regulators, and we spend a lot of time together talking about these issues. But as many of us, we don't have all the answers to what are really complex issues that need to be studied. I also have the great task of closing today's session. So thank you all for coming, and for all the panelists and for everybody. And thanks particularly to our sponsoring organizations, the Bank Policy Institute, the Wharton School at the University of Pennsylvania, Federal Reserve Bank of Philadelphia, Brookings, Columbia University, and the University of Cambridge. Thank you all for this and putting this together. And thanks to Jalapa and all the staff at the Philadelphia Fed who really have put this behind us and coordinated it well. So thank you all for that. My final word as we close is it's been a really very educational 2 days, in some ways a challenging 2 days to sit and listen to varying perspectives. What I take away most is I think everybody mentioned that there's a lot of opportunity to really do good through these relationships. And we need to continue this conversation across the regulatory environment, the private sector, and consumers to ensure we do this in a way that's safe and sound for everyone. But as John said, really allows us to leverage giving people better access to their financial capabilities, better access to credit, and a better life, hopefully, as they move forward. So thanks to everybody for what was really a wonderful conference. Appreciate it all. Enjoy the weekend and take care wherever you are.